All right. Thank you, everybody, for joining us today. This is going to be a strategy to use with a bullish market assumption, and it kind of correlates along the lines of with these earnings. So I'm going to show you how we can take advantage of several different things. One thing I say at the beginning of all of these webinars, you guys, this is being recorded. And uh, one thing I say at the beginning of all of these webinars is watch this again rather soon afterwards, even if you're familiar with this strategy. I mean, I know you guys can go out and read online how to do a call diagonal. That's not the point of this. There's going to be a lot of nuances that I try and teach you guys in order to set yourself up for success at the inception of this strategy. There's ways you can set this strategy up where you are setting yourself up for a loser almost immediately. As a matter of fact, you can set this up where you're paying more than the width of the spread, which means that you can't possibly be successful in this strategy. So keep that in mind. I'm going to teach you some of the nuances that you can do with this strategy in order to increase your probabilities of success and follow those rules. But watch this again so those nuances aren't completely lost. If you wait a month down the road, you're going to kind of forget about some of these. Thomas mentioning something from before we started here. What's wrong with the white hair? Hey, Thomas, I have gray hair. So, and welcome, Trevor. Thanks for showing up. Glad you guys could get in here because we are basically full. Anyway, moving on. So let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I actually started out trading in college with some money I had earned. I used to work on my grandparents' farm and detasseling, if any of you guys have ever done that. That's a lot of fun in August when it's super hot. But saved up that money when I went off to college. I invested some of that money in some stocks and then started trading options around those stocks. Switched my degree from psychology to finance and then moved to Chicago, walked around the floor, got a job in the pits, and started trading in the pits from there on out. And, so I've been trading in basically all the different markets. I've actually started out trading in the treasuries and moved around to the grains and the S&Ps and all that stuff. So I basically traded in all the different pits. In that time, I guess I kind of already started into this. I've traded everything from these stocks, financial futures, currencies, commodity futures, and options on all these products in all market conditions. And that's for over 20 years now. So I've seen a lot of crazy markets in those days. Anyway, any opinions, news, research, and analysis or other information contained here or other information is constituted as general commentary and isn't investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, what I'm trying to say here is it's general commentary because, for one, the SEC doesn't allow me to give investment advice because I don't know your risk parameters. I don't know what's in your portfolios. I don't know if it is actually appropriate for your specific purposes. So take what we teach you in these different webinars and implement it in your portfolios in your own way so that you're comfortable with that and it meets your risk parameters and doesn't send your portfolio out of balance in a sense. But the bottom line is do your own homework, and please remember the past performance of any trading system or methodology is not necessarily indicative of future results. Anyway, and you can follow me on Twitter at Wolfman's blog. During earnings season, I tweet out a lot of my earnings trades so that you guys get the opportunity to see what those are. Don't always say exactly what the strikes are unless they are a little bit different than what I would normally do. If it's something like a different strike, then I'll tweet that out. But otherwise, it's kind of, you guys should know at that point what those strikes are. So, and you can also follow us at Pro Trader Strat. I see a couple of people talking right now. You've already started. Yeah, but if you're catching it up right now, you just missed the most of the boring stuff, like the disclaimers on past performance of any trading system or methodology is not necessarily indicative of future results. You can't seem to find the recordings on your website. Trevor, usually we send the recordings out right afterwards. As a matter of fact, I usually get them. So I try not to miss any of your sessions. Learn a lot. Thanks, John. I appreciate the kind words. Jesse, I'm gonna have to find a second to read that paragraph. So give me a second, all right? All right. Anyway, so like I mentioned, this is going to be on the call diagonal spread. This is great for this time of season right now, where we're kind of rolling out of the earnings season. And I was talking to a couple of guys not too long ago. The earnings season seems like it's year round anymore, but at the end of the day, some of the ones that came out earlier on in the earnings season, this is going to be a great strategy for those when we're going into the next earnings season. We're going to be setting it up for that kind of situation, because this call diagonal spread does really well when you get expansion and volatility in those further duration contracts. So we're going to be trying to set it up for that. Excuse me. All right, so here we go. The call diagonal spread. Basically, what we're going to do is we're going to be buying an in-the-money call and a further expiration, and this is going to be the sweet spot for this. I find is somewhere between 65 and 75 days. That's the expiration that we're going to be kind of looking for. And the best case scenario for the out of the money call in the near expiration is usually around 45, 35 days. Now that doesn't line up perfectly with what we're doing right now. It's around 28 and 60, something along those lines, 28, 30 and 60 some odd days. But at the end of the day, what we're looking for here is being able to use this in the money call, and we're going to take that in the money call and we're going to finance it with this out of the money call, for the extrinsic value, I should say. So in the monies have intrinsic value and extrinsic value. The intrinsic value is what that option is actually worth, and the extrinsic value, to make it seem simple, is really time decay and theta, where that is going to decay ongoing. So what we want to do is get rid of the extrinsic value, and by getting rid of that extrinsic value, we're going to be selling this out of the money call and trying to finance all of that. All right. Why a diagonal and not a debit or a calendar spread? Well, in a sense, Trevor, you could use a calendar spread and it would be a debit spread. This call diagonal spread is going to be a debit spread, because this in the money call is going to be worth more than what we are able to sell this out of the money call for, because the out of the money is only extrinsic value and an in the money is intrinsic and extrinsic value. So the way we're going to be doing this strategy, it's always going to be for a debit. I don't ever do the call diagonal as a credit. I don't ever do basically a short call diagonal. The reason why is, that if you're selling that long-term option, even if it's out of the money, it's just going to take so much time to decay that there's a lot better option strategies than trying to sell option premium in really long duration. All right, so we're going to stay away from that. As a matter of fact, I don't even teach the call diagonal spread. We talked about it. I don't really want to necessarily waste your guys' time in a full-on hour webinar where at the end of the webinar I go, okay, so now that you learned how to do this, don't ever do it. Okay, so I don't do it on it. I have a couple shorter videos that you can watch, and I explain those different reasons as to why to stay away from that. Out of the money is the short and in the money is the long, correct. We're buying the in the money further duration, and we're going to sell the nearer term out of the money call. All right, no, you're right. We're buying the in the money further duration call, and because that's in the money, it's going to cost us a debit. Okay. If you continuously roll out and up, can you make a profit with the diagonal that originally cost more than the spreads? Any comment? Jesse, yes, you can. That's a good point. The problem is what happens if it starts moving up right away? And you're going to end up losing on that. So that's why I would stay away from that. But with this strategy, we have that opportunity to, if we can't completely finance all of that extrinsic value with this first sell, then absolutely, if this is going in our direction and we can roll this up and out, then that is always going to increase your probabilities and your profitability or your max profit potential on it. All right. Yes, we can keep selling. Yeah, I think I just answered that. We can keep selling this again and again and again. And no, Thomas, this is not the poor man's covered call. It's similar in some instances, but in that you can stay mechanical with like rolling it out, but it's just not going to be a very long duration one. And with the poor man's covered call, we're really trying to just take advantage of directionality and synthetically kind of having that stock in our portfolio, where this one we're just really trying to take advantage of volatility. Yes, you can still roll this up and out as even if it goes in your favor, if you're directionally correct. All right, so let me move along here. This is neutral to bullish. Now, the reason why I say neutral, and the only real neutral here, is that we don't want this actually to spike on us. Even though we are bullish in this strategy, ultimately, with especially that long duration option, we don't want this to happen really fast. And the reason why is it's the gamma and things of that nature in that front month move faster, so are bigger. The gamma on those nearer term options, especially when they start getting closer to at the money, start getting larger and larger, and that gamma affects the delta for every dollar gain in the underlying. So we're going to start out with somewhere around maybe a 15 delta, let's say. Well, that gamma in that front month is going to be closer to like 9 or 10. So that means on that second dollar move, that value of that short option is going to increase by 25 cents now. And again, it's going to increase by 40 cents the next time. So by the time it increases by 50 cents, it starts really hurting us. It doesn't always make it a loser necessarily, but it does make it very difficult to reach our max profit potential on something like that. So, and usually if it starts moving really fast, even though this is bullish and the general assumption is that volatility goes down on a bullish move, if you get serious spikes, that will cause volatility to skew towards the call side. As people try and jump on those calls and buy them up, that's going to inflate those values, and we don't want to really see that in the near term duration options. Okay, I got a lot of questions coming across. Until the UL doesn't reach the long strike. Right. We don't want it to reach the long strike necessarily. Not right away. I mean, if it slowly trickles up there, then that'll be okay, because theta is going to be eating away at those premiums the closer we get to expiration. And I'll show you that here in a minute, how that works. Okay. Why use the 15 delta again? Is it the one standard deviation expected move? Exactly. So that means that if we can sell something around that 15, 20-ish delta, we kind of will roll closer. The idea is delta is telling you what your probability of that option being in the money at expiration is. So you can look at delta as a percentage situation. So that's like a trader hack from the floor. Just like a 1 standard deviation is really a 16 delta, because that is 16% probability on the bell curve. Okay. All right. So essentials to success, picking the right underlying. Now, this is really important, you guys, and one of the most important things with options trading. Yes, you can go out there and find stocks like Aon. Aon has a lot of volume on it on any given day. Everybody has heard of that stock, but there aren't that many people trading Aon in the options. Just anytime you get, Aon's kind of a boring stock to trade anyway, but at that point, there's just a wide bid ask in those, and we want a tight bid ask in this option montage. So make sure that even if it's a popular stock, you go with the options that are really tight. And one of the rules of thumb I use for this, for some of you new guys, I know some of you guys have been in here a lot, I've heard this time and time again because I try and pound this home, is picking the right options. When you're in that option montage, you want the bid ask to be really no more than 10 cents wide on any stock that is under $100. All right, I'll say that again. A stock that is $100 or less, when you're looking at the calls and the puts that are pretty close to at the money, on like 30 days out, you go out 200 days, this rule doesn't really fit, but on those ones that are right there in that front month, if you will, that is needing to be from the bid to the ask 10 cents wide or tighter. Now, if it's a $300 stock or $500 stock, if it's a $500 stock, basically anything over $100, let's say, but for an example, a $500 stock, move that decimal point 3 ticks to the left, and the bid ask should be 50 cents wide. So look at it like that. A $1,000 stock, 3 ticks to the left, the bid ask should be $1 wide or somewhere very close to that. Okay, as volatility increases, if volatility is at 100%, that rule kind of gets skewed a little bit. But for the most part, like the apples and stuff like that, that's over $100 stock, and you'll see the bid ask in there 2-3 cents wide. And the reason why is that there's so many people in there trading, and there's so much volume and open interest that people are always willing to give up a little bit more edge in order to get filled. So if you have that kind of market mentality, which is what free markets are based on, then you're going to see those markets tighten up. If there's nobody in there, for instance, like Monsanto or something like that, a lot of people have heard of Monsanto. They actually used to have really good markets in there, but now it's a $100 stock, and those bid asks are like 30 cents wide sometimes. So in that case, I would just walk away from it. The reason why, you got to give up so much edge to get in. If I got to give up 25 cents to get in on a $50 stock, the price could be like 25 cents at 50 cents. If I got to give up 20 cents to get in because there's nobody there, then they take me out. That stock decays, or that option decays by 20 cents. Now I basically got to pay up 15, 20 cents to get out. So I basically, all of my yield has been eaten up in the spread width. Sorry, somebody doesn't know I'm doing a webinar right now. They're trying to call me. Anyway, so make sure that the bid ask is pretty tight on that. I want you guys to really take that and really take that to heart, because it is, those pennies will ultimately eat into your yield. Those pennies over the course of your trading career will make a huge difference. All right, picking the right strikes. This comes into something I mentioned a little bit prematurely, is we want to make sure that we're paying for that extrinsic value of those of that long call in that longer duration option. And we'd like to even prefer to get a credit for extrinsic value, because if you get a credit for that extrinsic value, in a sense, like if you're paying more than what the long-term duration extrinsic value is, you're really buying this stock for or buying this option for less than what it's actually worth. So that's difficult to achieve a lot of times, but there are a lot of situations where you can, especially if there's a big volatility differential in those 2 months. You can really do it, especially if volatility is higher in this nearer duration contract than the one that is in the further duration contract, let's say, which is a rare occurrence, but you do see that. And if you do have that opportunity, that means there's more volatility or more premium in those front months than there is in that back month. So you're getting paid more for selling that option in the front month than in the back month. A lot of times volatility is higher because of the unknown, and especially with what we're doing with this strategy, with the earnings are going to price in a little bit more volatility in that back one. But again, keep in mind, we want to get a little bit further away from where the market is, because we don't want this to shoot up right away. Keep in mind, deeper in the money options have less extrinsic value. So that we're talking about deeper in the money options, that means we're talking about that option that is further out, the one we're buying that's in the money. That's going to have less extrinsic value than those options that are really close to at the money. All right. So, and I mentioned, you can set this up where we lose at inception, where, we got a $5 wide diagonal and we're paying $5.10 or something like that. That isn't out of the realm of possibility, and it's not worth doing it at that point. Okay. See a couple other questions coming in here. So it's telling you that you will have an 85% chance of winning. Yes, the 15 delta is telling you you'll have an 85% chance of winning. That is correct. What is your rule of thumb for the weekly options regarding tight bid ask? Same thing, Farshad. The weeklies still need to have that tight bid ask, and I would just stay away from. I don't trade a lot of weeklies anymore. I used to trade a lot more of those, but there's just so much more opportunity in the regular month ones. But I did even look at a couple of them for this one, because we're at that time of the month where we're really seeing a lot of theta decay already happening, or a lot of theta decay has already happened in those options. So it's kind of difficult to get far away from the market and get a lot of credit. So and we'll talk about that a little bit more once I pull up the options chain, or the actual platform. All right, picking the right duration. I mentioned this a few times. The reason why this is key is because we want to get out here. I mentioned earlier, we want to get out 65, 75 days to expiration, because you can see right here, and I get this all the time, this isn't necessarily indicative of every market or every environment, but is a good visual to see what happens. And right now we're at like 28 days, so you can see we've had a lot of theta decay starting to steepen on this. So I like to get out here 35 to 45 days and get in there just before this all starts happening, because it's happening now. But on the flip side, we've had implied volatility spike the past few days, so it might help us out. But anyway, we want to take advantage of this theta decay in the front month and exploit this slightly less steep theta decay in the back month. All right. And the other thing is this is the one that we're going to be selling that hopefully has some type of earnings or a binary event. A binary event is an earnings event. A binary event is something that happens that will affect that underlying, if we're talking about bonds, it could be the FOMC minutes, or meetings, I should say. The minutes could affect it as well, but more so the FOMC. And you can land that on an FOMC. That would be a very similar situation to it. Another type of binary event, such as earnings with the underlying. All right. And then that front month decays rather quickly, and that gives us the opportunity to roll that out in time. I don't ride this into the end of the day, you guys, because remember I mentioned something about gamma earlier. The closer we get to expiration, that gamma starts expanding. So any slight movement affects that delta even more. So we're going to be looking to roll out of this with this front month with like maybe 75% profit on it. So I'd like to be out 7 days to go. I don't care about those extra couple of pennies here and there, as long as I can get out of that and not have to worry about it. All right. So the other thing is picking the right environment. This has to do with the volatility around the underlying, and this is the implied volatility percent. We want low vega and low implied volatility in and around that underlying as we're going. The reason why is because we don't want to have to pay a lot of money for the extrinsic value. And one thing that's really important with this environment is that the volatility in the month that we're buying should not be any more than like around 3% higher than the one we're selling, because if that volatility further down the option chain, further out in time has like a 10% difference, that means we're paying a lot more for that premium, and we're not able to, and if we are able to finance it with the near term, it means we have to go really deep in the money on that long-term duration contract. So if somebody is asking, what is the right strike of the option that is in the money, we'd like to shoot for around that 85 delta. But having said that, if there's huge volatility in that back one, that 85 delta could be really deep in the money. So what we want to do is kind of look at it, and we don't want the difference between those two option expirations to have more than necessarily a 3% difference. So, if the one we're selling is like a 14% volatility, the one that's in the back month shouldn't be any more than 17%. And there is opportunity that you'll see, like that front month one might have a fifth, like say 20, let's say, in the front month that we're selling, and that back month might have like an 18%, which means the one we're selling has higher volatility, which means we're getting more for that one. And I was hoping that we would see that sense of volatility spike, but we're really not getting that kind of skew right now. But there are opportunities. If you see that opportunity, usually that is a massive green light to go for, because you can sell that volatility and not have to go so deep in the money in that further duration. Okay, so we're looking for the IV in the front month to be low, and in the back month it's going to be relatively low in the back month as well if it's low in the front month, but we don't want the difference to be more than 3%, and I'll get into that in a little bit more detail here in a second too. All right, and so knowing our exit strategy. One of the things with setting this up, I forgot to mention with the picking the right strikes and things of that nature, how much do we pay for this strategy? I mentioned don't pay more than the width of the strikes, but one thing to keep in mind with this is don't pay more than 75% the width of the strikes. So for instance, if we have $10 wide, like we're buying, the underlying is trading at 50 and we're buying the 45 long duration call and then selling in the near duration, the 55 call, that's $10 wide, right? 45 to 55. So we want to pay less than $7.50 for that. And we're going to probably need a calculator for that, because sometimes they're like, $6 wide. There's going to be a lot of different variations there. So just pull up the calculator, divide what you are paying by the width of the strikes, and that'll give you what the percentage is. And then basically when the position's reaching about 50% of our max profit potential, so in that same example where we paid $7.50 for a $10 wide, that means our max profit is about $2.50. That means we're going to take about $1.25 out of that. So if we can cover that for $8.75, that's where we're looking to get out. And I'll go over that a little bit more here as we go along, but keep that in mind. We're doing a $10 wide. We want to pay less than $7.50. But for that example, we paid $7.50. Our max profit is then $2.50. So we want to cover it when we're at 50% of that $2.50. That's $1.25 gain, right? So you add that gain onto what you originally paid, and that's $8.75. What is your IV expectation after putting on the diagonal? IV, you want implied volatility to expand in that back month. So at the end of the day, we want the front month to expire worthless, and then we want to continue to see implied volatility expand heading into that earnings cycle that we are long that call. Because another reason for that is that if implied volatility starts expanding, even if we're directionally wrong, it will help us. Okay, because those premiums will inflate. So the market could actually, would be able to see in some instances the market kind of going down, but as volatility is going up, that increase in volatility is increasing the premiums and therefore increasing the premium that you bought, which offsets it in a sense. So we want we want implied volatility to start expanding in that back month as we near expiration, or near the binary event or the earnings or something like that. Whatever you're doing in that back month, you really would like to see volatility expand. And that's the beauty in selling, the one where it's flipped, where ID is lower in that further duration than where we're selling it, because it's probably, it's skewed, it's flipped, it's, backwardation in a sense is, I don't want to lose everybody, but backwardation, being the backward down, basically is an easy way to think of it. So if volatility is in backwardation where the back month is lower, then you would think it would go back into contango, which means it's higher, and it'll flip. And that is the perfect scenario, because it could go completely the market can go completely sideways, and you'll get that 50% of your max profit rather quickly. Okay, so basically you're just long a call at a discount. That's what we're trying to do, absolutely. We want to get long a call at a discount from where you could normally buy it, for sure. And so knowing your exit strategy, I talked about that, 50% of the max profit potential. And we're going to get into that right now. I kind of mentioned it a couple times. Max profit potential is the width of the strikes minus that debit paid. So we were talking about a $10 wide spread minus the $7.50 is max profit of $2.50. Now keep in mind that it could be considered unlimited because if that front month option is taken off or expires worthless, then we are just naked long a call, right? Also, because there's volatility differences, the max profit potential could also be a little bit different as well. Like volatility really expands in that back month and we see the real decay happen in the front month, then that profit potential could change rather dramatically when you see that volatility expand in that back month, right? Especially if you get like that backwardation to contango, you can see that flip really quickly. Rare occurrence in that situation, but it is able to happen. And your max loss is always the debit paid when you pay a debit for any option strategy, you guys. So that's the beauty in paying a debit, is your max loss. There's no other thing to worry about. When you put up, that's all you can possibly lose. All right. And then your break even is going to be that long call strike, which is that longer duration plus the net debit paid. So that's what I'm talking about. If you can pay down the extrinsic value, a lot of times that long call strike might be the 45 strike, the underlying's trading at 50, and we pay $4.50 for it. So basically we're getting that option. We're getting the underlying, in a sense, for 50 cents cheaper than where it's trading. If it was trading at 50 and we paid $4.50 for that 45 strike, that means your break even is at $49.50. It's below where the underlying is trading. Doesn't always happen, but you can get that to happen. And that is the best case scenario for it. All right. So here, I'm going to pull up the platform so we can start looking at this. And this is basically the time of the game where I throw it out to you guys to start throwing out some stocks that you want me to look at. We'll walk through it because I think you'll learn it a little bit better as we go through these steps and figure out whether or not it fits all of the rules in a sense. Are you looking for a situation where the long is in backwardation and you expect it to go into contango? I would love that situation. As a matter of fact, I would do this strategy in that situation without having earnings in it, just because more times than not, you're going to get it to flip again. Now, if there's not that's assuming there's no earnings in either one of them for the most part. If you're selling, if you're going to see that backwardation when you're selling in the front month and there's an earnings going on. Like for instance, one of these where Alta's got earnings coming up on the 24th, so next week. This probably has backwardation involved in the in this underlying. So for instance, this is the month that is going to have the earnings in it. It's 48, and you can see the further duration ones are 37. So that is what I'm talking about. That's backwardation, but that's because there's earnings in this front one. And I wouldn't do it if it was in backwardation and due to the fact that there is an earnings event in that one that I'm selling. Okay, does that make sense? This is Thinkorswim for TD through TD Ameritrade. Somebody's asking what software I use. All right. Did I get everybody? There was a lot of questions popping up at once, so if I missed your question, you can throw it out again. All right, so that would be a situation, backwardation. That's all this example is for, and you would expect that to happen. So, but you will see in other situations where you could get backwardation sometimes in the one thing I forgot to mention at the beginning, that's what I was doing the disclaimer. I'm going to be talking about some stocks that are in my portfolio, whether it's in my margin account or my IRA. I usually throw all my margin account trades into this one. I just put them in here just for the daily market commentaries to talk about. So I'm not trying to get you guys to limbing off the cliff with me. I'm just, at the end of the day, showing you different examples. So it's up to you. But anyway, sometimes you'll see like ETFs and stuff like that will get some backwardation and things of that nature. So you can play around with that as well. Right here is one. What is it? XLF, the financials are in backwardation. So this might be one that the idea is if you're selling it when it's in backwardation, we're getting paid more for selling these options than we have to pay for back here in these months. Now, and this is what I was talking about with 28 days, we're seeing already a lot of decay in these front ones. So it's a little bit more difficult, especially with the lower priced stocks. But some of the best pricing for this strategy is around somewhere between 50 and 100, because then you don't have to pay a ton. You're not paying like $1,000 or whatever for the strategy, or putting up $1,000 to make 1,200, or to make what would that be, probably $200 or $300. So that's also something to keep in mind. Try and shoot for those ones somewhere between $50 and $100. You can do it with all of them, but you're going to pay it on $1,000 stock. You're going to pay a lot for it, right? Before earnings for the long diagonal, we want to try and nail this in an earnings cycle. So, for instance, we can probably pull up a couple stocks because it doesn't show earnings on this. For it'll show you where they were, because this is the paper trading account. And for some reason, I don't know, they won't show you where the earnings are. So we'll have to cross-reference that with the regular platform. So like EA Sports, for instance, we're going to be looking at this month. This is the month we're selling, right, with 28 days to expiration right in here. So we want the earnings to be falling somewhere in this one. So EA Sports isn't necessarily going to get that volatility expansion in this month here. It's going to look like it on the chart, but it's not really going to affect these options nearly as much as the one that has the earnings event in it. And this is what I'm talking about with, we kind of want to, if we're selling in this month, you know, you're going to see that volatility expand up into the event. And we want to get out of these long calls before that event happens, because you can see what's going to happen here is volatility is going to collapse, and we're going to lose all of that extrinsic value that we gained in volatility. Because remember, volatility is part of the premium as well. It's theta decay, but what volatility does, in a sense, if we want to visualize it a little bit better, volatility has a tendency to, let me pull this away real quick. Volatility has a tendency to pump up the premiums, okay? So when we start getting down here, if volatility increases, if volatility starts going up, all right, starts going up here, what it does is it pushes this line and goes, and volatility pushes up and it holds off theta decay. And then when volatility comes out, it goes to the premiums. So if you think of this as what happens to premiums, this is what volatility does to premiums. It, you know, volatility pumps up premiums like that, and then when volatility comes out of it, it really comes out really quickly. So that's what we're trying to take advantage of. It's having that volatility pump up, but with this strategy, we don't want that long call to see this happen, right? We want to get out of there when volatility is at a high, in a sense. So don't ride this through the earnings cycle. And believe me, I've even read articles from like Goldman Sachs, and I don't know if they wrote this article in order to try and trick people into buying calls from them, but they said buy calls 5 days before the earnings, and then sell them the day after earnings, and you'll make money. I don't know what their percentage was, but it was ridiculous. The fact of the matter is if you get that volatility crush, you can be directionally right with those calls, and that volatility crush will eat up all your profits in a sense. So it's not worth it to do it. You're going to be much more profitable getting out before you go into that earnings event, right? What's the display to the right of the candles? It's called the market profile, and I use that as like for trading. It's basically, the reason why I like it, it's the psychology of the market. It tells you where the market's putting its money where its mouth is. These little numbers over here on the side you can't really see are is the time frames. It's every 30 minutes it adds another mark. So where it spends the most time is those things there, and the blue is where the most volume is traded. And you can see obviously with EA Sports, most time and volume was spent down here. It's where basically most transaction happens, and it kind of tells you where people find value on different stocks. I've done a whole video, several videos on how to trade that, so I'm not going to go into that a whole lot. All right, so EA Sports doesn't have that, and I saw a couple of people throwing out a couple of ones, but you know, first thing to do with like EA Sports, it's a $100 stock, so it's over $100, so we move it 3 ticks to the left, $12 wide. Just look at these to see if they're $12 or 12 cents, I should say. Move it 3 ticks. The bid offer should be 12 cents. And EA Sports is pretty close to that. It's not really fitting the bill on the market here. I do trade EA Sports, but I know there's a lot of open interest and volume in there. But this wouldn't fit it either because it's above a 50 IV percent. So, you know, what I usually do is just start at the bottom here and start working my way up from 0 IV percent all the way up. So that's got a little bit too high. Somebody was asking about BABA. So let's look at BABA. So BABA, first thing we're going to look for, you know, we would hope to have earnings in there, and I'm going to have to keep pulling up this this one here just to let's see where their earnings are. Their earnings don't fall in there, but that doesn't necessarily mean it discounts it. It's just that you know that volatility is going to expand in that one. You can use this strategy even without that, but it's nice to increase your probabilities of success by landing that long call in the one that has the earnings event. Those are just little subtle ways to increase your probabilities, you guys. If you know volatility is going to expand, that's where you want to be long premium, because premium gets pumped up. Okay, anytime you think volatility is going to go down, that's when you want to be short premium. Okay, just simple things like that will increase your probabilities of success. Like selling options in Clorox is not a good idea right now because it's at 0. And if you look at this, you can see if it's down here this low, the probabilities are it's way up here. You're way underwater if you're selling those there, right? So that's where you would want to be buying premium, because if volatility expands, and it likely will, because this is at the 52-week low, yes, it can go lower, but the probability is it's going to go higher. Just like when it's at 100%, it doesn't necessarily mean volatility is going to go down, but the probabilities are that it's going to go down. All right, so that increases your success rate when you play it like that. All right, so BABA doesn't have that earnings event, but you were the first one to throw it out there, so we'll look at it. And BABA, you move it 3 ticks to the left, we're looking at about 17 cents wide bid ask. And look, see, these are 10 cents wide, 8 cents wide. That fits the rule easily. The next thing to look at is this volatility here less than 3% difference to the volatility that we're buying? And yes, it is. You can see it's 1%. It's less than 1% away. Okay, so that meets that rule. That's the one I was talking about. The environment. You guys remember when I was saying know the environment you're trading in. This is the one I was talking about. It needs to be within 2 to 3 percentage points, and then that's when I started talking about contango and things of that nature, and backwardation being the best of all worlds in a situation like this. So this is contango, where this is lower and this is higher. Backwardation would be 28 or something like that. But having said that, it's fitting everything else. It doesn't have that one, but I would try and hit the earnings cycle in this one if I could. But if you were just bullish and wanted to play around with the strategy in there, I'm not one to say no. But we're going to look at that one that was around a 15 or so delta. It's a pick 'em between these two in a sense. Depends on how much you want to pay down here too. But we could look at it where what is the likelihood? So we're looking between the 85 and 90. So where's the 85 and 90? So 90 is way higher. So that's really good. So I'd probably go with the 90, since that would be well higher than the, or actually I'd probably pick the 85, since that's well higher than the current high made today. So it gives us, another $15, which BABA could cover rather quickly. But, we also got some volatility contracting here. So, but it's pretty close. So, as volatility contracts, it's going to contract out of this one at about the same rate as it contracts out of this too. All right, so I'm going to go with the 80 delta. I'm going to sell the 80 delta. And then I'm going to look to buy the one that has this much extrinsic value in it. So remember, I said the in the monies have intrinsic and extrinsic value. Another floor trader hack. You look straight over to the opposite option, and these are the hint. It's not the exact number, but it's very, very close. This number here tells you what the extrinsic value of these options are. The real way to figure it out is you take the 145 strike, add in, $24.50. So you're talking $24.50 puts that at 160 169.50, right? So 169.50, subtract that out, 169.50, got $2 is what that's saying, just off of a ballpark of me like figuring it out, but it's saying $2. So it's probably really closer to this, and we'll see that happen when we'll figure it out once we do this. So, but the ballpark we're saying is around 130, so we look for this one, 130-ish. So this would be the one that we're looking to buy in a sense, and we buy that. All right. Next thing we look at for BABA to see if this is going to fit the rules, you know. So we got the green light on the width, we've got the green light on the difference here. Now we have to figure out if we're paying less than 75% the width of the strike. So we're paying $23.06. So $23.06 divided by the width of the spread here, which is 35, right? 45 to 80 is 35. So divided by $35 gives you 65%. So that meets that rule, okay? You know, this is what I was talking about. Sometimes you can see this where it's 100% the width, and you don't want that. So that fits that rule. Now the next thing we want to kind of look at is we add this debit in, figure out where our break even is. Take this debit, we add it to the 145 strike. That gives us 168.06, right? 168.06. So you can see that it didn't pay for all the extrinsic value. 168.06 were, 50 cents away. So it was closer to $2 of extrinsic value in these options here. But at the end of the day, it's usually much closer than that. Usually pretty dead on for something like that. So then you have to kind of weigh your benefits. It fits every other rule. It's 50 cents off, but it's $100 stock. It had a $3.50 move today. So you just have to know that your break even is above where you currently are. So that I would say is like a yellowish light on the fact that it's above us. But as much as this moves around, it probably would work. But you have to kind of weigh that. All right, am I willing to accept that my break even is above where I am? Why not sell the 150s? Sell the 150s? Sell the 150s that are in the money here? Is that what you're asking? Oh, buy the 150s. Why not buy the 150s? We could look at it. What did I do? The 145. So you could buy the 150s because then you're going to have to try and pay for that. We could look at it. It might work out pretty good if you're, if you don't think it's going to go to 175, that definitely works, Trevor. It might even be set up better. So we did the 150s, $2. Selling those, we probably surely covered extrinsic value on this strike. So $25 wide. Let's just make sure that's in line with this. I think it is. $17. We paid we're paying $17.65. Divide that by the width, which is 25, to figure out what our percent is. It's 70%. So that works out better. Great call, Trevor. That's why I have you in. I let you back in here every once in a while, Trevor. No, I'm just kidding. Okay, so that works out great. Trevor came up with a great one. So that puts us at one. We add this into the 150 strike. It gives us 167.65. 167.65. So that's right there. That's much better. Still slightly higher than where we are, but that could happen in a second. So great call, Trevor. Thank you for pointing that out. And we have less risk to the downside because we're paying less for this strategy altogether. So that works out quite nicely. Go Trevor, Amaro says, go Trevor. Keeping it real. All right. All right, so we're kind of running close to time. So that was a great example. Another one I'm going to look at for you guys that I'm going to be looking at doing on probably Monday or something like that, depending on how this premium happens. So let's look at EA Sports. So this is what I was talking about with not EA Sports. What did I say? eBay. eBay, see how the earnings fall on the month that we're looking for. So eBay fits the rule of, that's going to increase our probabilities because this volatility is going to expand. Now, this is very close to $3 wide. I think this expanded a little since I vetted this particular one, but 3% wide. I mean, 22 to 25, 3% wide. That's close enough. It's I guess a yellow light we would look at it. So we're just going to have to figure out everything else to see if it fits the rules. And we're going to be looking at buying like the 32 delta. Let's look at, because that's 44 cents. I'm just trying to go back and forth here. So let's look at buying these. And at eBay, looking at $34 stock, 3 cents wide, 3 cents wide. It gets a little wider out there, but it's very close. It meets that rule. So going out here, we're going to be looking at, the 32 strike, let's say. That's close. And then we'll probably do the 36 strike. And, you guys can always add this in with your charts and figure out, okay, well, for me, I would be looking at this first value area high to act as resistance in a sense. And you could even look at this for where you're buying your strike, 33s, 32 I'm buying, so I'm still going to be in the money. And this might even be a situation, if it continues to go down a little bit, this would be where you would roll it out through the weeklies, because eBay, the beauty in when you have really tight markets here, the weeklies will too. So the weeklies are having 4 cents wide. So somebody was asking, do I do the weeklies with this strategy? Absolutely, you could. We could even look at selling the 35 days in the weeklies in something like this as well, which we will do to compare it. All right, so that one, we've got $4 wide, $3 we're paying for it. So let's just do it for $3. $3 divided by 4 is, I know you guys can do this in your head, 75. So that fits. All right, so now where's our break even? $3 added onto this is 35. Right? $3.35. So, 30, what is it? 34.98. So it's a little bit higher. So let's take and check out the options in the weekly. So let me delete this one. Still buy the same 32s. It doesn't have a whole lot of extrinsic value. And look at these. So we could probably do the 36s. Did I get it? Oh, no. It flipped on me. Sorry. My computer froze for a second. So the 32s sell the 36s, which is basically the same strike there, $2.91. So, we got a couple extra pennies for it. I might, for 5 cents or something like that, go with these because, it's 7 days less. I want to get all I can for that. And then in that regard, because there's so many tight months here, we could roll this out. Once this decays to say like 15, maybe I could buy it back for a dime. Then I would look to roll it out here and higher, roll it out and up if you can. Okay, but that one fits pretty good. So just make sure that those, just go through that checklist just like that. Looking at the underlying bid ask, how tight is it? Okay, that fits. Then look at this. All right, that fits. It's a couple cents difference. And play it that way. So I see a couple of questions getting it. Do I get a doggy bone, Trevor? Yes, you do. This diagonal looks different for the others than you trade. The other diagonal requires 10% drop or increase in price. Is that correct? Yes, this is a little bit different because we're setting this up for the earnings, and we have a bullish assumption in here. Are you equating the debit plus the strike with the stock price? Yes. So basically what we're trying to do with taking this debit and adding it into what this long call is we're trying to figure out if we paid for all the extrinsic value, because we don't really want to see this, if this is going to decay, but if we pay for all of the extrinsic value, then, this one's going to decay, and so is this one, relatively close rate. This one will decay faster, but if this one decays faster and we use this money here to pay for this, then we'll be profitable quicker. Does that make sense? Because that further duration is going to hold on to theta longer than that front one decays. And if that front one paid for that one, then the premium will still be a little bit higher. Does that make sense? These are all neutral to bullish assumptions. Absolutely. And as a matter of fact, you know, look at it like, you know, if you have something that, you know, like Apple, I don't know if, you know, Apple or something like that where it goes straight up, I don't know that I would necessarily do that, or has a tendency to spike. But, you know, this is the reason why I ultimately would probably go with this eBay one is because you can see eBay has a tendency to really lose a lot of volatility and gets really low, and then it slowly starts ramping up, and that's what we want. We want to be buying that further duration one with very low implied volatility, and then let it ramp up because those premiums start inflating the closer we get to expiration. And then this is exactly why we don't want to hold it one day after or to the expiration. We don't want to hear the earning event, because boom, we could be right all of that, and we could probably lose, you know, $1 in value and be directionally right. It's just not worth it. All right, Tom, thanks for joining us. Appreciate it. He's got to go. All right. Doing this analysis for every stock is really time consuming. Is there a Wolfman hack to avoid all of the time consuming steps to qualify a stock? There really isn't, but you can know that if it's really low down here, or, you know, somewhere up into the 30s, if you have the IV percent over here, that's the quickest way to do it. But, you know, the more you play around with these, you will be able to go through it and immediate, you know, for one, all of these stocks over here, I know, other than like Aon's over here somewhere in Monsanto. Here's Aon, and this is what I was talking about. Aon is 100, you know, look at how wide those are. They're just ridiculous. 25 cents wide. And Aon I just do because I like to watch the stock, and Monsanto is the same thing. But I don't really trade those. If you watch my daily market commentaries, you know I don't even watch those. So I do watch them. I don't trade them. I don't trade the options in them. So that's the easiest way to do it. But really, it's pretty easy when you have all of this closed down. You can, like, when you're flipping through stocks that you're thinking, okay, they just had earnings, you know, like about, you know, 2 or 3 weeks ago, they should be setting that up for earnings coming forward. Like the bank stocks are all having earnings coming up in this October cycle. Excuse me. So you know that that's going to expand on those, and then just quickly look at it. You know, you can easily look between SEP and October here that, you know, it's within 3 percentage points. So it does move rather quickly. And if it's within 3 percentage points, then you can almost rest assured you're going to be able to get this strategy to work out with the rest of the rules, the 75%. This, you know, when you're doing the calculation on the 75%, that's really just to double check yourself. You will find it every once in a while where it goes over 75. It'll be like 80, 90, you know, 95%, and then you just got to be like, all right, well, that's an anomaly, kick it to the curb, let's move on. Right? So a couple of them, do you want to break even to be less or greater than the underlying price? You want the break even to be less for, you know, the best case scenario to get it less. Did I lose anybody else? Because it looked like Golem thought it was too technical, and it's actually very easy. It's just, I put a, you know, you can go online and find out how to buy it diagonal. Don't get me wrong. I'm well aware of that. But the fact of the matter is you need to have these different little nuances, you know, tight in your head so that you set yourself up for success. Because you can read it online how to do a diagonal. They're going to be like, you buy, you know, you buy a further duration contract and you sell a near duration contract. There's your diagonal. Boom, go. You know, fly, be free. Well, they don't tell you that, you know, that could cost you $10 for $10 $1.10 for a $10 wide strategy, and that's not a good situation. So I want to make sure that you guys are setting yourself up for success. So I have gotten it a little bit technical on this one, but at the end of the day, watch it again, and it will maybe the first time be a little confusing. Second time through, it won't. So, the idea here is to increase your probabilities of success by making sure you're setting it up with the right environment, making sure that you know that the tight bid ask is going to happen, and those volatilities, all that stuff put together increases the probability of success. And that's what I want to teach you guys. I want to make sure that when you do this, a lot of people think options are low probabilities of success strategies because they lose money in them and stuff like that. Well, the reason why is because they haven't set them up properly. You actually, with options, have a higher probability of success than any other trading strategy out there, even more so than just going out and buying stocks. This is the only way to really increase your alpha, in a sense, is by trading options. So I want to make sure you guys have that, and you guys need to be trading with this knowledge. So we got a great offer right here. This is actually has to do with a lot of earnings options strategies, things of that nature. There's actually 10 hours. There's I think there's 8 classes, over 10 hours of trading strategy and how to set them all up. So if you've enjoyed my instruction at all, especially if you guys are one of my regulars, this is really important to do. You guys know how much I love to trade options during earnings, and just because the probabilities are so high. So take advantage of this. You could probably make that in one trade on a one lot in the on the earnings. So, and I talk about all the probabilities, how to increase those, where to set up the strategies, and the best way to become a better trader is to constantly learn, which clearly you guys have already done that by joining, and I appreciate it. But wouldn't you say that just knowing how to create an option strategy, like going out and reading it online, isn't going to be nearly as effective as if you actually know the nuts and bolts in and around that strategy? Or even just trading the technicals wouldn't be enough to create consistent winners. At the end of the day, go and check out right there in the chat window. So in the chat window, we have this particular strategy or this particular offer. I'm going to throw it in there right now so you guys can go in there and click on it, take advantage of that. It's only for today, so make sure you take advantage of it. Actually, and if you are part of the list that weren't able to make it into this webinar because we were full, you guys can take advantage of that now. Basically punch this into your URL then if you aren't here, which is the same thing as here. But take advantage of that because this is a huge opportunity for that. So increasing the probabilities, that's exactly what I teach in all of my classes, and how to play those probabilities. And when the probabilities have gone against us, what do you do? How do you stay mechanical in order to increase your probabilities even further? I don't know if you guys are watching the daily market commentaries. I had John Deere stock going against me. I had it on a put spread, and I stayed mechanical with it. I rolled up my puts and things like that, and ended up working that strategy into becoming profitable. So I'm constantly staying mechanical, and I teach you guys how to do that, which they don't teach you how to do online. They just tell you how to set it up and fly and be free, kind of thing. So I teach you how to increase your probabilities by staying mechanical. And like I mentioned, options is the best way to increase your probabilities. And especially in and around earnings, you need to know that. So, if you're using the right tools in the right situation, you guys are going to be more productive state of mind. You guys are going to be able to put on more strategies, which means more opportunities. And ultimately, that's going to build your confidence, because if you are new to options and you go out there and you do a strategy, like a friend of mine was like, I hate doing covered calls. He was like, first time I did a covered call, basically I got called away from me. And I was like, well, for one, that's a rich guy's problem if your options are getting, or if your options get your stock called away from you, because that means you made a lot of profit on the way up, directionality. But the other thing is, so the probabilities got you that one time. If you were consistently doing this over time, you would lower your basis of what you paid for it, and ultimately that increase in profit would have shown up when it finally got called away from you. So it's a perfect scenario, you know. Basically, 9 times you would have sold those calls, lowered your basis, and on the 10th time it got called away from you. Well, in the meantime, you lowered your basis by probably over $2 on them, on the stock he was talking about, which happened to be Waste Management, I think, which I wouldn't necessarily sell options in that, but you know, it is what it is. He liked that stock. So we're offering this for you guys today. So why don't you just go ahead, click on that in the chat window, take advantage of that. Also, you know, make sure you check out the daily market commentaries, because I go through every single one of my trades, how I stay mechanical. If a trade goes against me, I talk about it. So I talk about the winners and the losers, and I talk about the losers more than the winners, because the winners are easy. They come and go and I forget about them. But the losers are the ones I stay with, like that deer trade, and turn it into a profit by staying mechanical with it. All right. So if you learned anything from me today, you guys should trade with this knowledge. And, you know, that's what I hope. You guys at least got to take something away from this new, which hopefully will easily pay for something like a $36 deal here, and things of that nature. So, all right. Can you do a strangle instead of a diagonal? Yeah, you could do a strangle, but a strangle you want high implied volatility for, right? And Trevor, check it out. I know you're a long time guy, so go in there and look at the one on strangles, because I do those a lot. Can you run down the rules one more time, please? Yeah, Chris, I will. Give me 1 second. Let me answer a couple more. Can you put the link in the chat? I think I did put the link. Can everybody see the link in there in the chat window? I think I figured it out this week how to do that. Took me a little bit of time. I'll just hit it again. There's another one. Okay, everybody. Oh, Chris got it. Okay, you see it and used it. Thank you, Dave. Appreciate it. All right, so Chris, let me get to your question real quick. Okay, so let's just run over these real quick. I'll go back. I just flip through these real quick. And this would be good for everybody, I suppose. So picking the right underlying, that has to do with that tight bid ask that we were talking about in the option montage, right? So something for Aon doesn't fit that. It's a stock that's under $100, needs to have the bid ask on these closest to expiration, not necessarily the zero, but the closest to expiration, 10 cents wide on the stock that's under $100. It's over $100 like Aon, move it 3 ticks to the left, and it should be 13 cents, 14 cents wide, which this does not fit the bill on. So kick it to the curb, because you have to give up too much edge. If I sold these 60s, if I sold these for 60 cents and 10 days later I could buy them back for 60 cents, that doesn't make any sense. You know, it decreased by 30 cents or so, but I just took all that risk and wasn't able to make money. So that's why we don't do that. Go to something like a similar price stock, and they're even worse for this one. So, well, 13 cents wide. I don't know why these are so wide right there at the money. It's good. Another thing is on a Friday after the close, these guys are not going to leave in their trades over the weekend and get picked off on Monday morning. So a lot of times it'll pull out. But we can look at these, 12 cents wide, which fits the bill. 3 ticks to the left, 13 cents wide, that fits. Okay, and Win does usually have pretty decent markets in there. XRT, a $38 stock, we're talking 6 cents wide. So, we can go on to Han or any of those. IBM is another one that's going to have tight bid ask for the most part, 10 cents wide. All right, so that's the first thing we look at. The next thing we look at is whether or not the month that we're buying and selling are very similar in volatility. So we just look across the way. This is 16, and then the one that we would be buying is 19. So it's slightly over that 3%. We want less than 3% difference between these two. The third thing we do is whatever the width is, so we paid, if the width is $10 and we pay $7.50, is it 75%? So we're paying 75% or less the width of what the underlying is, okay, or what that strategy is. $10 wide, we're going to pay less than $7.50. We don't want to pay 80 cents. We don't want to pay $8 because that's like 80%. $9, it's 90%, okay? And then the duration, we want to take advantage of the duration because we want our front months that we're selling to decay faster than our back months. So duration, somewhere inside of 35 days that we're selling and somewhere outside of 65 days that we're buying because it doesn't decay nearly as much. And the beauty in this is if we financed all of the extrinsic value of these options and these decay faster, it makes us profitable. It makes us get to that rule of knowing our exit strategy. Knowing our exit strategy, right? Our exit strategy is taking 50% of the max profit. Now, in that example where we were talking about, we paid $7.50 to get that 75%. Well, our max profit then on a $10 wide is $2.50. So if our max profit is $2.50, right? Because we paid $7.50, the width is $10. That means the max we could make is $2.50. Half of that is $1.25. And that's what we're looking for, to have $1.25 profit. So if we take that original $7.50 we paid plus the $1.25, we cover when we get to $8.75. Does that make sense, Chris? I know I flew through that fast, but that's it in a nutshell. Okay, great. So for all you guys saw that, clicked on it, appreciate it. Take advantage of that because it's not going to be around for much longer for sure. And we still have a couple of earnings coming up, so literally 1 or 2 trades you can take advantage of that and pay yourself in a sense. Are you able to take one question? Yeah, John, I got you. What you got? All right, with volatility lower in the front month and later month higher volatility, aren't we doing it backwards since selling lower volatility is reverse to the usual, right? Well, yes, but the idea, the reason why we're bending that in a sense where we're looking at it like we're actually paying for low volatility, right? If we expect that volatility to expand, like we were looking at in eBay. Of course, eBay's not up anymore, but IBM does the same thing. If we're paying for this low volatility and we bought it down here, or another situation, this would be the month we would have been buying, right? Because we would have sold this month and let that decay, and this would have been a perfect scenario in a sense before it sold off, but we would have been out before then. We would have sold this front month, let that decay. It's trading sideways. As this is trading sideways up here, you can see volatility is expanding. So that's what I was talking about earlier on, where if volatility expands, it's going to hold off that theta decay. Remember where I drew in that red line? It's going to hold it off. And a lot of times, if it spikes like it did here, that could have been trading sideways and theta would have been eating at it, but this volatility expansion going up would have made us possibly profitable. I'm not going to guarantee it did, but you can see that as this is trading sideways, this is going up rather quickly. That would have tried to offset that in a sense. And if you get the best of both worlds, where this traded sideways like this, those front options expired worthless, and then the market continued going higher, volatility expanding, we would have been really profitable rather quickly. What are the delta of the options to buy and sell? I start looking at around the 85 delta that we buy and the 15 delta that we sell. and kind of play around with it from there. But ultimately what it's going to come down to is, where you are able to get enough money in that near term to finance the extrinsic value of those further duration options. Right? 16 delta has a 1 standard deviation, correct? Does it mean that the strikes at the 16 delta has a 1 standard deviation expected move? It just means that those doesn't it mean, well, in a sense, yes. If you look at a bell curve, a 16% probability on a bell curve is the probability of that ever being hit. Isn't the 1 standard deviation the 68.4? No, that's well, yes, because you're basically taking the 16 and 16, which is 32, and 32 plus 68, right, is 100%. So 1 standard deviation is a 68%, but that's on both sides. That makes sense? 16 on one side, 16 on the other. Right? All right, that's all I got for you guys today. Thank you guys for sticking around a little bit longer. I hope you guys enjoyed this. Later times we're going to be drilling down on different option components when they're appropriate. This also is the link. If you didn't get to watch this because we were full today, just pause it and write this down. I want to thank you guys for watching. You can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right? If you can't take that, take it easy.